Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind corporate filings, and today we're diving into Prospect Capital Corporation's latest filing. It looks like they're raising a bunch of money through new debt offerings, and we've got all the juicy details on what that means for investors and the company itself. Now, before we jump into the nitty-gritty, if you appreciate getting straight insights from these corporate documents, make sure you are subscribed and have notifications turned on. We also have a Discord community linked in the description below where we discuss these filings and more. Alright, let's cut to the chase. Prospect Capital Corporation, or PCC as we'll call them, is out here issuing new notes, basically borrowing money from investors. They're calling them Prospect Capital Internotes. We're talking about 3 different series here, with maturities in 2028, 2032. Let's look at the numbers for those 2028 notes first. They're issuing $2,313,000 worth of these, with a 6.25% coupon rate, paid semi-annually. That means investors get paid twice a year on these notes. The principal amount is $2,313,000 and they're selling them at 100% of that value. The net proceeds they expect to get is $2,286,978.75. Every little bit counts, I guess. Then we have the 2030 notes. This is a smaller chunk, $46,000 in principal. The coupon rate is a bit higher at 6.500%, also paid semi-annually. They're selling these at 100% too, and the net proceeds will be $45,218. And finally, the 2032 notes. This is the smallest offering at $17,000 principal, with a 6.750% coupon rate. Again, semi-annual payments. Net proceeds here are $16,668.5. All these notes are set to trade starting the 8th of December 2025, and they'll settle a few days later. Essentially, PCC is borrowing a good chunk of money and plans to pay it back with interest over the next several years. Sounds pretty standard for a company like this, but let's dig into the details to see if there is more to it. So what does PCC actually do well? They're a financial services company that lends money to and invests in medium-sized private companies. They operate like an investment company, but they're managed from the outside. Looking at their recent activities, it seems they've been busy. They repurchased some of their existing debt, specifically $20.3 million of their 3.437% notes due in 2028. This is interesting because it shows they manage their debt portfolio actively, sometimes buying it back. And get this, they recently issued about $167.6 million in debt with a 5.50% interest rate due in 2030. This was a big offering in Israel, and the notes are actually in Israeli currency. They plan to use that money to pay off other debts and for general business purposes. The kicker is that these notes are rated pretty well, getting an Elia rating from Cephs Global Ratings. That is a solid rating, suggesting they are seen as a low risk for default. Oh, and here is a fun fact. Their company stock actually started trading on the Tel Aviv Stock Exchange under the ticker symbol PSEC recently. That is quite the global reach. From a legal standpoint, it looks like everything is in order. Their vice president of legal and outside counsel have given their opinions that these new notes are indeed valid and binding obligations of the company. This is important because it means the company is legally committed to paying back this debt. Now, let's talk about the risks, because no investment is without them. Investing in these notes comes with risks. The company is already carrying a pretty hefty load of debt, and this offering just adds to it. They're talking about nearly $2 billion in unsecured senior debt, and another $700 million in secured debt as of early 2023. Adding more debt makes it tougher to meet all their payment obligations and can limit their flexibility for future investments. They also mention the risk of credit rating changes. If a rating agency decides to downgrade them, or even pull their rating altogether, the market value and ease of selling these notes could take a hit. That is a big deal for investors, as it could mean losing money if they need to sell their notes before maturity. This is a crucial point. These new notes are unsecured, meaning if PCC runs into serious trouble and can't pay its debts, the people who lent them money with secured loans get paid back first from whatever assets are available. Only then do the unsecured note holders get a look in. Plus, any debts held by their subsidiaries are also prioritized over the parent company's debt. So, in a worst case scenario, unsecured creditors might get very little back. And here is another red flag. The legal agreements, the indentures, that govern these notes offer pretty limited protection for the investors. PCC can issue more debt, sell assets, enter into transactions with affiliates, and do a bunch of other things without needing the note holder's permission. This means investors have less control and fewer protections if things go south. They also talk about a survivor's option. This is basically a clause that allows heirs to request the repayment of a note if the owner dies, under certain conditions. However, PCC has the right to limit the total amount they'll accept for these requests each year. So while it sounds like a nice perk, it is pretty restricted and not a guarantee heirs will get their money back smoothly. And finally, they can't guarantee that there will even be a market for these notes after they're issued. This means selling them before they mature might be tough, and investors could be stuck with them for the long haul. To understand where PCC is putting its money, let's peek at their investment portfolio as of December 2022. They've got investments in 130 companies and other financial products. Their total investments are valued at a massive $7.8 billion. That sounds like a lot, but remember, it is spread across a lot of different companies, some of which are privately held and less liquid. For example, they have a significant investment in CP Energy Services Incorporated, with loans totaling over $48 million and preferred units and stock worth more than $31 million. That is a substantial chunk of their funds tied up with one company in the energy sector. Then there is First Tower Finance LLC, where they've provided a loan totaling over $370 million. That is a huge amount of money lent to a single entity, and it looks like a good portion of their equity investments are in this company too. This heavy concentration in a few companies is a major risk factor. And National Property REIT Corp is another big one with over $87 million in loans and a whopping $663 million in equity valuation. That means a huge part of their portfolio value is tied up in this one real estate investment trust. If you look at the breakdown, a lot of their investments are in companies more than 25% owned, meaning they control these companies. Then there are companies owned 5% to 24.99% where they have significant influence, and finally, companies less than 5% owned. A good portion of their debt holdings are in the energy sector, with some high interest rates, but also in non-accrual status, which means those loans are not generating any interest payments right now. That is concerning. Now, let's talk about their stock structure. PCC has authorized a massive number of shares, around 1.5 billion for common stock and another 447 million for preferred stock. They've already issued a good chunk of common stock, about 399 million shares by early 2023. This large number of authorized shares gives them a lot of flexibility to issue more stock in the future, which can be good for raising capital, but also dilutes existing shareholders. Their common stock trades on the Nasdaq under the ticker PEXEC. Importantly, they've gotten approval from their stockholders to sell shares below their net asset value, or NAV. This is a big deal. It means they can issue new shares at a discount, which can bring in cash quickly, but also significantly dilutes the value of shares held by current investors. They've explained why they do this, citing the need for capital, the potential for new investments, and even the benefit to their investment advisor who earns more fees when more money is managed. But let's be clear, when they sell stock below its true value, existing shareholders who don't buy more shares get less of the company's overall value. Purse hair. Imagine you own shares in PCC and they decide to sell new shares at a discount. If you don't buy any of those discounted shares, the value of the shares you already own effectively goes down. The table here shows that in a 25% discount offering, your NAV per S hair could drop by 5% if they do a massive 100% discount offering, which sounds crazy. Your NAV could drop by 20%. That is a huge hit to your investment. They also have a dividend reinvestment plan, or DRIP. Normally, reinvesting dividends is automatic and can be a good way to grow your holdings. But here is the twist. For PCC, when you reinvest your dividends, they'll give you shares at a 5% discount to the market price. So while it sounds like a deal, it's another way they can issue stock at a discount, potentially diluting the value for those who don't participate or take cash. So, what is the verdict on PCC? They're actively managing their debt, issuing new notes to refinance and manage their capital. They've got a significant portfolio of investments, with a heavy concentration in a few areas, which is a definite risk. The ability to sell stock below its NAV is a double-edged sword, providing needed capital, but at the cost of diluting existing shareholders. It seems like they're really focused on growing and managing their assets. But these debt levels and the potential dilution are things investors should watch very closely. Now, looking at these results more broadly, PCC appears to be aggressively pursuing growth through debt and equity offerings. Their strategy of lending to and investing in private companies can offer high returns, but it also comes with significant risk, as highlighted by their accruing loans. The concentration in a few portfolio companies like First Tower Finance LLC and National Property REIT Corp means their performance is heavily tied to the success of those specific businesses. The fact that they can issue stock below NAV while providing immediate capital significantly impacts the value for existing shareholders. It is a tricky balance for management trying to grow the company while keeping existing investors whole. Alright, that is our breakdown of Prospect Capital Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Do you see their debt strategy as a path to more growth or a potential pitfall? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description for more insights and discussions. Thanks for watching. See you next time.